This video will cover the Rise trading model from start to finish. I'll first start off by giving a small introduction about myself and the goals that brought me to create such a model. If you don't want to hear about all of that, you can just skip to this timestamp here in the video. To give you guys a little insight into who I am, my name's Oliver. I'm a 20-year-old day trader from Canada who has had the chance to meet this wonderful community of ICT traders on X. And I did not start trading ICT. I started pretty randomly out of YouTube videos, which is bringing me back to my roots at the moment. And I feel very much blessed to be in a position where I can share my knowledge right now. And I am in a position where that knowledge will be valuable. By the way, if there are any questions of credibility, feel free to head over to my Discord or my YouTube channel, which are all linked on my Twitter page. I post daily price action reviews on every day I trade and weekly outlooks. And I believe that is all that is needed in terms of transparency. But if there are any others that are questioning, I have multiple executions and account P&L on there as well. I believe that there is no question to have about that. But to talk a little bit more about my journey here, well, as I said, I didn't start on ICT. I learned who ICT was this August, and that logic about smart money was already something that I believed in. So now that I had the true creator of said concepts, I could utilize them and combine them in a way where I could create a versatile and very profitable model, which was always my intent with the Rise trading model, as it will be known further on after today. With all this free educational content that ICT released right here on YouTube, I was able to learn from them and combine them in a certain way to fit my goals the best. Those goals were very specific. They were centered around consistency and versatility. I wanted to be able to catch moves in any type of condition and to maintain very consistent net results but hit rate, because results will always vary depending on market conditions, at least in my opinion. But what I wanted to remain stable was my hit rate. Why? Because for me, being right more often than not was more important than making more money. And so, for the past few months, I've been creating and backtesting a very specific model, which is a combination of ICT concepts that to me were either better or more important than others. Some example of these would be power of three, the understanding of how higher time frame candles are formed, more specifically in which order they are formed, alongside SMT, and of course, time. I then utilize all of these concepts in confluence with session liquidity and a unicorn entry model to give me the highest probability trade. As ICT said it himself, the unicorn entry model is the highest probability entry model, and utilizing session liquidity presented in the One Setup for Life video is how you achieve high consistency. But as most people who are going to be watching this video are beginners, please listen to my following words. When you are utilizing the Rise trading model, you are trading the second phase distribution of a market maker model. Do you need to know what a market maker model is? Do you need to be able to recognize a market maker model? No. So stop trying to understand everything and to know everything. There is no point. Your goal should only be to achieve profitability through consistency. So lock in, utilize one model, and this is a framework that I'm providing right now, which is my specific model that brought me to said level of profitability. To keep the explanation simpler, I'll be referring to higher time frame charts as 4 hour and above, my intra-week time frame as the 1 hour chart, intraday time frame as 15 and 5-minute charts, and lower time frame as 1 minute or below, which we will not be going over in this specific video but can be utilized for advanced traders. In my eyes, every model has 4 different aspects: bias, narrative, framework, and entry model. In this video, we will not be going over bias and narrative, which are generally related to higher time frame context and direction. We will, although, be going over framework and entry model. For the rise model, framework starts with time, more specifically with the logic shared on the Twitter thread about the economic calendar that will be linked below this video. We want to concentrate on only high probability trading days. Once we are within said high probability trading day, we will look at key levels in liquidity and in time-based liquidity to look for an objective to be met and a specific pattern to form at these higher time frame points of interest. When trading in our lower time frames, we want to be catching a higher time frame expansion to have a lower time frame low resistance liquidity run. We also want price to confirm our idea through specific order in how the market structure is provided to us. As for our entry model, how we will later trade said framework that we have found, we will be utilizing a unicorn, which is a breaker block with an overlapping fair value gap or inverted fair value gap. We will also be utilizing premium and discount to give us higher probability trades, always making sure it aligns at specific times. Before diving into an example of the specific logic and order in which we want these things to appear, there are two ways to be going at trading this model. There's the conservative approach and the aggressive approach. An example of a conservative approach would be to only trade on high probability trading days, take profit 75% of your position at your low-hanging fruit objective, only trade setups where SMT is present, while also only trading in your higher time frame direction. A more aggressive approach would mean that you would trade every day but the day before very high impact news like CPI, FOMC, or NFP. You would take profit 50% or even less of your position at your low-hanging fruit objective, leaving the rest on as a runner. That would allow you to trade more setups while also trading intermediate time frame retracements. Both approaches will be profitable if you execute correctly, but as for myself, I preferred a better stress to reward and more time to myself, so I decided to be trading the conservative approach. A setup first starts with a clear bias and narrative, which is not something I'll be going over in this video as I have said before. You need clear direction and how it will reach said direction before moving forward. Once you know where price is going and how it will get there, you are looking for this specific pattern to form in price at specific times, as we have said before in our framework. You're looking for a breaker block to form within a higher time frame point of interest. Let's dive deep into this. For any breaker block, you first need a range, and a range is from a swing point to a swing point. Looking at the example right now, for a bearish range, we'd be looking at a swing high to a swing low. You then need that swing high of the range to be run for liquidity. You need a stop hunt to go for that high, as you see right here. That stop run has to be into a higher time frame point of interest, which can be either a higher time frame inefficiency or higher time frame liquidity. Once you have that manipulation into your higher time frame point of interest, you want to see displacement in the opposite direction. Once you have displacement below the low of the breaker range, you now have a market structure shift form. You can then look for your breaker block within that range and an overlapping fair value gap or inverted fair value gap, which will be your unicorn. That unicorn is your entry. If you are trading the conservative approach, you can also add a rule that your entry has to be in the premium or discount of the range form from your manipulation to your current low. Now that you have an entry for your setup, you also need a clear invalidation level and clear objectives. To find an invalidation level, you can use the ICT 3 PD array rule. Since we are currently bearish, we'll be looking for bearish PD arrays. Your first PD array would be your entry. So in this specific example, it would be our bearish fair value gap. But now we would look at two bearish PD arrays higher to also allow for invalidation. So if I have two fair value gaps above, my stop loss, my invalidation level would allow for price to trade all the way back to that highest fair value gap, but not invalidate it. So I would have my stop at the high of the fair value gap candle. If I am also using order blocks as PD arrays for my stop loss, and they are in close relation to a swing high, I will put my stop at the specific swing high instead of the order block high. I will be showcasing the 3PD array rule more in depth in the examples later. But what about objectives? Well, with this model, you have two clear objectives. You will have a low-hanging fruit objective, which you will be able to find by using the premium and discount of the current range. You can also use standard deviations as confluence to find your discount and efficiency, which would then be your low-hanging fruit objective. Why? Because that is where it will reverse if you are wrong with your direction. Your final objective can be found by looking at external range liquidity while also still using standard deviations as confluence. If you entered based on a liquidity framework, it would also be the opposite end of your liquidity framework. With a conservative approach, this would be your final take profit where you would fully close your trade. With a more aggressive approach, you can also keep a small part of your position. I would recommend lower or equal to 15% to then leave on as a runner. With a bullish example, it would be the same thing. You're looking for a stop run into a higher time frame point of interest, which can be an inefficiency or pure liquidity, followed by displacement in the other direction. That displacement will form a market structure shift alongside your breaker block. You will then find an overlapping fair value gap or inverted fair value gap that will be your unicorn entry. You will use the 3PD array stop loss rule to find a clear invalidation level, followed by utilizing premium and discount in confluence with standard deviations to find a clear premium and efficiency to be your low-hanging fruit objective. Your final objective would still be at the external range liquidity or at the opposite end of your framework, still utilizing standard deviations to have high probability objectives. As I stated previously, I will not be going in depth about time and how to utilize time to find these specific setups. The easiest way is to always align your setups with silver bullets. You have the New York AM silver bullet, which is from 10 to 11 a.m. And then you have the New York PM silver bullet, which is from 2 to 3 p.m. New York time. If you align your trades to always have distributions be at these levels, which, as you might notice, also aligns with 4-hour power of 3 with a new candle opening at the start of each silver bullets, you will be able to find high probability trading setups in line with time. There is a way to get deeper understanding by utilizing such things as macros and even time cycles, but I will not be going over them here because I am not teaching the model, I am sharing the model. Now that you know exactly how to recognize one of these setups, let's go look at 3 examples I have prepared for you. If you want to see more examples, join my Discord where I do daily price action reviews on high probability trading days, and I look at every setup that formed. I also sometimes do some live trading where we can see setups form real time alongside weekly outlooks to talk about my bias and narrative for the week. In the Discord, I will also share complete data about this specific setup, at what times specifically they're formed, within which time ranges, what is the average stop loss, the average target, the average risk to reward, average consistency. I will be going in depth about every little part of this specific model, but I will keep that solely for the Discord, so join if you want to see that. For our first example, we'll be looking at NASDAQ futures on Friday, April 19th. We have just taken external range liquidity on the previous day and have now retraced to our premium of our range, more specifically into a 4-hour bearish fair value gap, which will be our point of interest for this specific trade. Now diving into our 15-minute chart, our intraday time frame, we can see a London framework forming on both ES and NASDAQ. Overnight, we have taken London highs, making an overnight jitter swing, leaving London lows open. Moreover, we also have relative equal lows at these levels, which are a clear objective. We also have SMT, which is additional confluence that the high has been put in and that smart money is currently accumulating short orders to head towards London low. Now heading lower to our trading time frame, our 1 minute chart, we can see price form a bearish breaker block. This is a high probability breaker block because it was formed inside of a higher time frame point of interest, which is our 4-hour bearish fair value gap. We also have our overlapping fair value gap, which forms our unicorn. We enter here and place our stop right here utilizing the 3 PD array rule. First PD array is your entry bearish fair value gap. Then you also have the bearish fair value gap above alongside the bearish inverted fair value gap, which means that your stop loss placement will be at the high of this candle for the inverted fair value gap. This gives you a 39.75 handle stop and allows for at least 2 risk to reward towards your low hanging fruit objective, which you can then leave runners on afterwards to head towards your higher time frame objective, which would be 4-hour external range liquidity in this specific setup. After a little drawdown, you can see that we have reached our objective, and at this low-hanging fruit objective, this is where 50 to 75% of your position would be taken out. Depending on what? Well, it depends on, as we spoke before, which type of trader you want to be. For our second example, we'll be looking at a lunch trade from the 16th of November 2023. As you can see, after the end of the lunch session, we have raided lunch lows into a discount inefficiency. We are now going to look for setups to form within this leg to displace towards lunch highs. Now diving into our 1 minute chart, our trading time frame, we can see that after raiding lunch lows into our 15-minute discount fair value gap, also respecting consequent encroachment, we expanded higher. We would then wait for 2 p.m. power of 3. As you can see, price opened, went to put up a low, which also formed our bullish breaker block. With this bullish breaker block, you see this inversion fair value gap, bullish inversion fair value gap, aligning with said breaker to form your unicorn. You would then use this order block and this order block as your second and third PD array, as they are in closest proximity, to give you your stop loss at 9.75 handles. You would target your relative equal highs as your low-hanging fruit objective, because it is the first objective in the premium of our current range, and then leaving a runner on all the way to lunch high to complete your framework. You could also use standard deviations of your breaker block to add confluence to that move. Moreover, if you want more consistent results, you would use the bodies of said breaker block to give you even more precise standard deviation levels that adds confluence to your objectives. Now looking at a previous PM framework, as you can see post 9:30 open, previous PM session highs have been rated and we opened within the range from said high to previous PM low. All you are waiting for after your important liquidity level has been taken is for your entry model to form. As you can see right here, there were no bearish breakers until this one right here, also forming with SMT with the S on the highs, which then displaced lower, giving you your market structure shift, forming your breaker block. Then you would utilize this overlapping fair value gap, the first one, to enter on this candle, targeting previous PM low as your low-hanging fruit objective, and you also had 4-hour external liquidity for your higher time frame objective. Again, to utilize your 3 PD array stop loss rule, you have this inverted fair value gap, this main fair value gap alongside the fair value gap above, which would give you a stop at the high of this candle for a nice 2.89 R to your low-hanging fruit objective. For our final example here, we'll be looking at ES. A low of day was formed utilizing SMT with NASDAQ inside of a daily bullish fair value gap. You would expect an internal to external move out of this. As we can see, that move prevailed, and we also had 10 a.m. high impact news. More specifically, the University of Michigan consumer sentiment. As you can see, with that news brought manipulation lower into our 15-minute discount inefficiency, also taking out liquidity for additional confluence. Now heading lower to our 1 minute chart, our trading time frame, we can see clear as day our 10 a.m. power of 3 with accumulation, manipulation, confirmed by SMT, into our discount intraday fair value gap before displacing higher, which formed our breaker block. Utilizing standard deviations and the opening range high, you had a clear low-hanging fruit objective, and it reached all the way to terminus and passed, as we have seen, to our daily external range liquidity. You had your unicorn form right here with this as your second PD array, this inverted fair value gap as your second PD array, alongside this order block to give you this clear invalidation level. Taking into account we are also inside of the 1050 to 1110 macro, and as ICT says, that macro will often spool against profitable AM traders, which have been short up to now. I will not be going over any more examples in this video, but just the fact that you made it all the way to the end here, you're already part of the minority. You're part of the people who actually want to do this for real, want to make trading their full-time career. So listen up. In the Discord, I give weekly insight into where price is going, but most importantly, why it is doing that. I explain along the way, as well as giving you detailed price action reviews on every single day I trade, alongside trade breakdowns of the setups that formed that specific day, whether I missed them or traded them. You cannot get better insight into learning this model and learning to get a profitable trader anywhere in the markets right now. And I will stand by that. I will always provide free value in the Discord, even though at some point it will turn into a premium subscription. There will always be free weekly outlooks and trade breakdowns along the way. Join this community filled with people just like you who are trying to make it, and I will provide the value that will make it worth your while.